Hi everyone and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. And now that stocks are firmly in new all-time highs, is it time to get bullish or more defensive? William O'Neill & Company will provide perspective on that and weigh in on two big media names duking it out in the streaming wars. Plus, we're taking a look at Roku in this week's technical analysis. The streaming device maker stock has had its fair share of volatility, but could now be the time to buy. And we're sitting down with ProShares to talk about dividend strategies for your portfolio through an ETF lens. Investing Strategies starts now. Let's get started with this week's market insights. The stock market has been powering to new highs on a weekly basis for several weeks in a row now, boosted by positive trade headlines. But do the new highs signal a sustained continuation of a long bull run, or is it time to get defensive? Here with me now to discuss market conditions and analyze a few stocks is Randy Watts, Chief Investment Strategist at William O'Neill & Company. Thanks so much for joining me today, Randy.
Thanks for having me back.
All right, so we've seen quite a few up weeks and new highs in a row now. What's your take on what we've been seeing lately?
Well, first, the technical picture of the market has greatly improved and is actually pretty positive right now. If you look at years where the market has this kind of a move in the first 10 months, normally it has better than average returns in November and December. So the setup for the end of the year is very good. In addition, in years where the S&P goes up 25% or more since 1928, 71% of the time, it's happened 17 times, 71% of the time the next year is also an up year positively. And then if you look at sort of underneath the broad indices, right now 9 of 11 O'Neill sectors are above their 50-day. That kind of breadth is encouraging. And in addition, over the last 4 weeks, technology and healthcare have been doing better. So that's good for growth stocks. So that's actually making us feel more confident about the move we're seeing right now.
That's right. We are seeing a lot of momentum. So you think that bodes well for a next big leg higher, although there are others out there who are saying it's time to get defensive.
Normally, when you have this kind of technical action, it does carry forward. And then I think the market's really being driven by three things right now. The first is that earnings season, which has just completed, was better than people expected. People had pretty negative views going in, and it ended up being better. And it looks like hopefully forward 12-month earnings estimates for the S&P 500 are starting to firm up and stabilize. Second, there's been a lot of liquidity pushed out by the central banks. If you look at the PBOC from China, our Fed, the ECB in Europe, and the Bank of Japan, those central banks have all been adding liquidity. And in fact, October was a month that saw the most liquidity added since last December. And some of that liquidity is clearly finding its way into U.S. stocks. Finally, active investors in general are behind the market indices. So I think there's a little bit of a catch-up trade as active managers try to keep pace and improve their performance relative to what the market's done this year.
Right, because it has been a bit of a volatile year, but it sounds like the bull case is still very much intact, at least for growth investors and momentum investors. But we do also have this other school of thought of getting defensive. And meanwhile, we're seeing low levels of fear in the market. What does that
tell you? So the VIX is actually very low right now. It's around 13. But if you actually look at the cost of volatility on derivatives, it's very expensive right now to hedge yourself on the downside, but it's not very expensive to buy upside optionality. What that means is people are actually still pretty conservative. So despite the fact the market's at an all-time high, despite the fact it's been a great year for the S&P, people still aren't really totally believing this rally. If you look at history and you look at sentiment, that means usually that this momentum can carry on for a little bit longer.
Right, a bit of a contrarian indicator there.
Absolutely.
Well, we'll definitely keep an eye on those current market conditions, but let's turn our attention to our industry spotlight this week on the streaming wars. Now, the latest chapter in this saga, of course, is the Disney Plus streaming service coming out a little bit earlier this month, Apple TV Plus at the beginning of November. What do you think of these latest developments in this group with a lot of eyes on it right now?
Well, Disney's a stock we really like. It's on our U.S. focus list at William O'Neill & Company. The stock right now is making new highs. It's been keeping pace with the market. It's got a relative strength right now of about 84, and it's under accumulation. So we really like Disney. We think the streaming move is a big deal for them. The company said they added 10 million subscribers in the first 24 hours of launch from last Tuesday to last Wednesday, so that's very encouraging. Obviously, they're not the first entrant, but they're a leader in content with franchises in Marvel, Star Wars, Pixar, as well as all the legacy Disney content. So we think this is going to be very attractive to consumers. In addition, if you look at their pricing, they're only charging $6.99 a month for Disney Plus. That compares to the standard Netflix plan of around $13. So it's less expensive, and it's being led by a lot of very strong brands. So we think the prospects are very good for Disney in this area.
Yeah, and you mentioned those 10 million subscribers or signups in the first 24 hours. We don't know the mix yet of paying versus the trialists or getting it with your Verizon subscription, but they also had a deal for locking it in really for a 3-year time period. So it does seem like they're really making the case for hooking families on to this product.
And one thing I think that's interesting and good that they're doing is on their streaming shows like the new Star Wars show or The Mandalorian, they're only releasing the episodes weekly. They're not putting the whole series out at once so you can just watch all the episodes in a 24-hour period. So we think that is going to actually help keep churn down and keep people engaged. In addition, they're supposed to have about 25 new series over the next year and 10 new movies. And many of these series and movies are in franchises people know, like Lady and the Tramp from Disney, some new Marvel TV shows, a new Star Wars TV show. So I think that's going to help keep the audience engaged.
Right, and then in terms of the stock, on that news of the 10 million subscribers, the stock just shot up. Do you think now that the hype is priced in here, or what could we see for the stock in the next couple of months here towards the end of the year?
So I think over the next 5 years, if you look at the stock from now to 2024, if they can make their estimates, which is adding 60 to 90 million subscribers for Disney Plus and get to profitability at some point in 2024, we think the stock can move higher because they're adding a major new business that they control. It should have pretty good margins. Also, Disney is one of the largest content creators in the world. They spend about $24 billion a year on content, including sports rights. So they have a lot of product they can put on this service to really capture new subscribers. And we think there's a global aspect as well. They've rolled out in the US, Canada, and the Netherlands. They're going to roll out in Western Europe next year, in March, I believe. So I think there's a lot of potential for this service, and we're pretty excited about it and the stock.
That's right, and we are seeing them spend a lot of money on new content, but they also have a lot of legacy content that they're benefiting from too. And spending money on content is not unique to Disney. Netflix and Amazon and others are in this really big battle for buying quality content. So let's shift our focus to Netflix because they were the first mover in this group, but the stock has gotten hit quite a bit with all of this competition that it's facing.
Yeah, technically, we don't like Netflix right now. The stock is trading underneath its 50-day, though above its 200. Hopefully the 200-day can act as support for that. It's got a weak relative strength. Right now, the relative strength is about 24 on the O'Neill system, and the stock's not under accumulation. In addition, the stock's not hitting new highs as the market is. So it's kind of out of sync with the market right now, and I think the reason for that is that investors are worried about the Disney entry. In addition, when they reported their quarter in October, they missed the new sub ads. They were supposed to do 7 million was the guidance. They added 6.8. That's a good number, but it is below what their guidance was. That's the second quarter in a row they've missed their guidance. Now, they have 158 million subscribers worldwide. That's split about 50-50 US versus international. So they're still the dominant player, but again, they haven't been making the sub numbers and they continue to burn cash. Netflix spends about $15 billion a year on new content. That's a very strong number. They spend more on streaming than Disney. Disney's probably going to spend $2 to $2.5 billion. But remember, overall, Disney spends $24 billion, so they have a lot of content there. And Netflix is burning cash. The estimates for this year are for them to burn about $3.5 billion. Disney just finished their fiscal year. They generated $1.7 billion. So one's burning cash and one's generating cash. Long term, that could be an issue for Netflix as the cost of content continues to rise.
Exactly, and we know that other players, from NBC to HBO, also ramping up their plans to get into this space. But one more note on the technicals for Netflix. You talked about the relative strength rating. Can you talk about what goes into that?
So that's really analyzing how the stock looks versus the other stocks in their market. So in this case, in regards to the U.S. market. And really, stocks that have the best performance tend to be north of 70 on the relative strength rating. The thing we always say at O'Neill is, right, you want to own a leader, not a laggard. Netflix has been a laggard. Until we can see it start to regain positive relative strength versus the market north of 70 and get above that 50-day, we would really avoid the stock.
All right, well, some interesting thoughts there on this ongoing streaming war. We'll definitely keep tabs on it. And it looks like we could see some continued upside for Disney. So
we think both for Disney and for the market.
All right, sounds good. Thank you so much, Randy. And coming up next, we're going to continue the streaming theme with a look at a streaming device maker for your watch list. Back in a minute.
Are we ready to do this?
Okay, here we go.
Good morning, everyone, and welcome to IBD Live. IBD Live is for just about any investor.
IBD Live is a look behind the curtain.
It's kind of bringing our subscribers into that whole conversation that we're having on a daily basis.
You're just going to be fully immersed in the rules of growth stock investing.
I think IBD Live, honestly, is probably one of the best values out there because you get to leverage off of others' experience.
You're going to speed up your learning curve dramatically.
If you really want to know what's happening right now, what can you do today, IBD Live is where you should be.
If you capture one or two of these stocks, it's going to pay for the subscription itself.
Learning in the stock market is a lifelong adventure, and I think IBD Live helps make it an exciting and hopefully a profitable one.
When you're looking for stocks to buy, sometimes aggressive investors can find alternate entries that allow them to initiate a position at an earlier price point. Let's use Roku as an example. Now, the streaming device maker has surged as much as 476% in 2019, and it's provided investors several buying opportunities along the way. Now, the first buying opportunity was here when Roku broke out of a first stage base back in May. The stock gapped up and surged some 28% on a quarterly report that showed accelerating revenue growth. After that, shares ran up from $83 to about $108 in less than a month and a half. Then Roku pulled back to its 10-week moving average and rebounded higher. Now, the first two rebounds off of the 10-week line after a breakout are considered chances to add shares to an existing position. There are also opportunities for aggressive investors to start new positions. So Roku had two of these rebounds off of the 10-week line, one here in July and then another one in August. And by September, the stock was trading above the 176 price level. At that point, it was also well extended above this 10-week line, signaling the stock was due for a pullback. Now, if we flip over to a daily chart, we can see the sell-off in more detail. And with the sharp selling, investors should use the 10-week line or the 50-day line on this daily chart in heavy volume as their signal to sell. And this is also why it's a really good idea to take profits on the way up. And this action after a big run indicates that the stock needs time to consolidate again before it can offer a new buy point. And fast forward a bit, shares gapped down on earnings in early November, but then quickly rebounded. Aggressive investors got a new buy point here when shares moved above an early entry at 151.58. Now, even though this resembles a cup with handle chart pattern, it's not a proper handle formation, and that makes this an aggressive entry. Now, proper handles only need a minimum of 5 days to form, but the best ones will clearly also show up on a weekly chart. Now, this one does not. But the real reason why this is not a proper handle is because the depth of the handle is 23%, whereas the depth of a proper handle should be about 8 to 12%. This handle is also too low in the pattern. It should form in the upper part of the entire pattern. But with all that said, it doesn't necessarily mean this entry point can't work. Aggressive investors just need to keep an eye on those sell signals. And for investors who aren't as aggressive, see if the stock can form another handle that's higher and tighter as the stock approaches old highs. All right, well, when we come back, we're going to talk about dividend strategies for your portfolio through an ETF lens. We'll be right back.
This season on Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
Today's ETF Strategies segment is brought to you by State Street Spider ETFs. And even with the market at record highs, 2019 has definitely been a volatile year. One strategy for weathering market turbulence is by investing in companies with attractive and growing dividends. Joining us to talk about dividend strategies for your portfolio through an ETF lens is Simeon Hyman. He's Global Investment Strategist at ProShares. Thanks so much for joining me today, Simeon.
Thanks for having me.
All right, so we are at record highs or near them, but it's been quite a volatile year. So tactically, how should investors be approaching their portfolio to tackle all of this volatility?
You know, this is, as many people have referenced, one of the most hated bull markets we've ever seen. And yet it keeps going up. One of the reasons why you kind of have to be invested is, what are your alternatives? I mean, bonds are still extremely expensive, yields are starting to creep up, so there's risk kind of everywhere, and you kind of need to participate, but perhaps in a way that's thoughtful. And that's really where the dividend growers come in, the opportunity to have a strategy that, you know, offers some good defensive attributes, but also participates quite well as well.
Right, and with companies that are growing their dividends and have a long track record of doing so, also speaks to the quality of their fundamental performance as well, right?
That's exactly right. You know, at ProShares, we focus on a suite of ETFs focused around dividend growth, and the hallmark is, as you mentioned, the long track record of continually growing dividends. You can't lie about dividends. You have to have the cash flow. You have to have the margins. All those things have to be there, and it's what contributed back in last Q4. We forget that there was this big sell-off last Q4. Tremendous downside protection, and yet participation reasonably well this year. So if you look at what would almost be 5 quarters at this point, you see the proof point of these strategies that, as I said, are sort of a great solution for, I hate this market, but I gotta be in it. Let me be in it with high quality companies.
Right, so let's take a look at Noble, which is the S&P 500 dividend, so-called aristocrats. Can you talk to me about what all goes into the selection of the companies for this ETF?
Yeah, it's a pretty straightforward strategy. You have to increase your dividend for 25 years in a row. You have to be in the S&P 500, and that makes you a dividend aristocrat. And that long track record, and by the way, we equally weight the companies in the index, and that's important too, because it's kind of like an active manager who had equal conviction. That signal of dividend growth is sort of equally predictive across those names, and it helps get the most outperformance, you know, out of the strategy. And again, you have to have high quality, higher margins, you know, longer track records of earnings growth even in difficult environments, all the things that you would think that would come with that. And something extra that I think is important, it's a signaling aspect. You know, there's been a lot of conversation around buybacks and dividend growth. Hey, aren't they the same thing because it's just giving cash back to shareholders? I would argue not really, because a buyback, when a company does a buyback, it's telling you the good times were yesterday. But a company that increases its dividend, because you never want to cut one, is telling you they're expecting the good times to be on the way as well.
Interesting. So in terms of utilizing this in one's portfolio, do you see it as more of a long-term holding, or especially something that you would want to focus on during times of heightened volatility?
Well, it's a great long-term core holding, and the nice thing about dividend growth, and we also have our mid-cap strategy, ticker REGL, as well as small cap. SMDV, and they sit very nicely, well behaved, not dramatically tilted towards growth or value, really sitting there in a nice position in a portfolio such that they can be a very, very effective core holding for an extended period of time.
And then there's other pockets of the market too that you can use this strategy for, right?
Indeed, we're focused on looking to deploy that dividend growth signal, perhaps sometimes in places where people don't expect it. We just launched ticker TDV, which is our technology dividend aristocrat, and that's applying that dividend growth screen to the technology sector to get that pile of stable, older growth technology companies with that signaling aspect, lots of upside, but again, a lot higher quality, higher profitability than some of the newer and perhaps more high-flying names. And we also recently launched ticker TMDV, which is our total market dividend grower, and that's out of the Russell 3000 in the U.S. to offer one-stop shopping for those who find that as convenience as well.
Right, so there are a lot of different opportunities for investors who are interested in looking at that long-term dividend growth. How would you use a mix of these perhaps in a portfolio, or would you just pick one of them that speaks to your strategy the most?
Our approach was to really offer them across the waterfront. So I mentioned NOBL large cap, Regal mid cap, and SMDV small cap. So that gives an investor the opportunity to construct out of their preference for how they want to weight those to get their full U.S. market exposure, or for those who find our total market alternative to be a more straightforward solution, that's available as well. But also the tech piece is an interesting one, because what we found, as an example, in small cap, which has been out for a number of years now, you'd be surprised at how effective that screen can be in places where you wouldn't expect it, because that quality aspect can retain a lot of the growth, because remember, the dividends are growing, but have nice downside protection and screen out some of the less profitable or more volatile names that perhaps you wouldn't want in your portfolio.
Yeah, that's a good point. At Investors Business Daily, we're really focused on the fundamentals, so stocks with strong earnings and sales growth. So perhaps there are even ties to that kind of strategy as well, if you're looking at the dividend growth as one of your signals for strong fundamentals.
Especially when you go smaller in capitalization. The Russell 2000, 40% of those companies don't even make any money. So applying a dividend screen there, a dividend growth screen, can be very valuable in getting a quality slice out of that. And we think that the opportunity in tech with TDV is there as well.
All right, well, a very fascinating discussion. Thanks so much for shedding light on this topic for us.
Thanks so much for your time.
All right, and thanks everyone for watching Investing Strategies. Next week, we're doing a deep dive into the ESG investing trend. Investors Business Daily has partnered with MSCI to come up with a list of stocks that not only have high ESG ratings, but they also get top ratings from IBD on key fundamental and technical metrics too. Until next time, I'm Alissa Coram.